Welcome everyone to BDO's webinar focused on professional service firms. My name is Anna Jarrold and I am the tax partner leading on our professional services tax service offering in the UK. For those of you who don't already know, BDO is a global accounting network with over $9 billion in revenues, operating in 167 countries with over 80,000 people. Our speakers today, Eddie Doyle and Mark Hines, are both from BDO's Dublin office in Ireland. Eddie is a partner who specialises in advising on partnership and corporate tax matters, and Mark is a director and provides tax consultancy and compliance advice to professional service firms and also other high net worth clients. You can ask questions during the webinar. Please use the Q&A feature, which is at the bottom of the middle of your screen, and we will address as many of the questions as we can at the end of the webinar, or afterwards if time does not permit. We'll also record in the webinar and we'll email you the slide deck as well as the link to the recording in a few days. We will finish within an hour. I will now hand over to Eddie.
Hello, good morning everybody. I hope you can all hear me clearly. First of all, apologies in advance. We've got two speakers here, myself and Mark, who are suffering from a touch of man flu, so the sound quality might be the greatest. I'd like to thank Anna and our colleagues over in BDO London for giving us this opportunity to speak with you this morning. And basically I'm going to take you through just a presentation. I'm going to cover, first of all, just a general overview of the Irish tax system. Secondly, then, we're going to move on to some structure options for professional services firms establishing or setting up in Ireland, particularly then moving on to overseas firms operating in Ireland. And then Mark is going to take over and talk us through some payroll tax issues, including secondments. And then, as Anna said, we'll have a Q&A at the end. So without further ado, I think, yeah, great. So first of all, just an overview of the Irish tax system. I suppose the first thing to say for those of you who are from the UK, our system is very similar to yours. It's obviously based originally on the UK system, so a lot of the principles and terminology and indeed calculations and computation rules are very similar to what you have in the UK. I suppose one of the main differences we have is we have a calendar year here for tax purposes for income tax, so rather than your 5th of April, ours is the 31 December year end. Our income tax rates, there are two income tax rates in Ireland for individuals, 20% and 40%. We then have, in addition to income tax, universal social charge, which is a temporary tax which was introduced here roughly 10 years ago, but I suspect it'll still probably be a temporary tax in another 10 years. And that has a progressive rates going all the way from 0.5% to 11%. The 11% rate applies to all non-employment income in excess of €100,000. We also have social insurance here. It's referred to as PRSI, and it has a 4% rate for employees and self-employed, and an 11.1% rate for the employer. So therefore, if you are an income tax payer, you're basically paying, your marginal rate of income tax in Ireland then is 55%, which is 40% income tax, 11% USC, and 4% PRSI. So it's quite a high personal tax regime in Ireland. On the corporate side, I suppose the story is slightly different. We have a very low corporate tax rate. We have a 12.5% rate for all trading income and a 25% corporate tax rate for non-trading, which would be investment income, rental income, or any other form of passive income. In the case of professional services companies, we also have a surcharge, or potential surcharge, of 7.5%, and that is applied to undistributed profits of a company, of a professional services company, where the profits are not distributed within 18 months of the year end. There's an additional 7.5% surcharge applied in that instance. We have a dividend withholding tax of 20%. We have professional services retention tax, again relevant for professional services firms. And this is a retention tax which is withheld by all government and state bodies on professional fees paid. The tax is fully creditable against the income tax or corporation tax charge, but it's simply a withholding mechanism. Standard VAT rate here, certainly for professional services, is 23%, and then our capital gains tax rate here is 33%. There is provision for a 10% rate for certain entrepreneurial relief, but our standard rate of capital gains tax is 33%. So that, I suppose, gives you a framework or an overview of the Irish tax system and the rates. Our filing regime is quite similar to what you have in the UK. For income tax purposes, we file here, and it's a pay and file system on the 31st of October of the year following the tax year. And for corporates, the filing date is 9 months after the end of the accounting period. So just looking at some structure options for professional firms in Ireland, we have, first of all, a general partnership, which is probably the most common structure for professional firms operating in Ireland. In the case of legal services, a form of limited liability partnership, or LLP, has just been introduced here from the 1st of November 2019. That's actually, it was legislated for back in the Legal Services Act of 2015, but was awaiting a commencement order, which was issued in November of last year. So we're just seeing that coming into play now, the limited liability partnership for legal, and it's only for legal services. The other, and I'll speak about it a little bit later on anyway, the next, I suppose, most common structure is your normal limited liability company used by certainly a lot of non-legal and non-accounting services, so architects, quantity surveyors, those type of activities would generally be in a limited liability company. And then finally, I suppose, a bit of a variation. A lot of the larger professional services companies here who operate through a general partnership, or indeed going forward as an LLP, would also have a separate service company running in tandem with the limited or general partnership. And again, we'll go into that structure in a little more detail in a couple of slides. So just looking in the first instance at, say, the most common structure, which is a general partnership, or in the case of legal firms now, the new LLP. First thing is looking at the partnership, or the LLP itself. Unlike the UK, our new LLP for legal service is not a body corporate, so it is treated exactly the same as a general partnership in all respects. So the partnership itself does not pay any tax on its income. It must, however, lodge a partnership tax return declaring all income and expenses and the allocation of that income between the various partners. The partnership itself is liable for payroll taxes and VAT. So from an income tax perspective then, it is the individual partners who are taxed on their share of the partnership income from all sources. And again, as I mentioned earlier, that would be at the highest marginal and social insurance rate of 55%. Any foreign resident partners in an Irish partnership will be taxed in Ireland on their share of the partnership income attributed to Irish source income only. And again, the maximum income tax rate for such individuals would be 55%. If it is a foreign corporate partner, the rate would be most likely at 25%. Looking at the limited liability company structure then, a limited liability company, as I mentioned earlier, will be taxed in Ireland on corporation tax at 12.5% on all trading profits, or 25% on any investment profits. Any after-tax profits who are distributed out to shareholders will be treated as franked dividends and subject to our withholding tax, subject to treaty relief. As I mentioned earlier, there is a corporation tax surcharge here applied of 7.5% on undistributed profits. In the case of shareholders then in a limited liability company structure, Irish shareholders are taxed at their marginal income tax rate with a credit for the dividend withholding tax withheld. Non-resident shareholders receiving franked dividends have no further liability in Ireland, and no dividend withholding tax would be imposed on distributions or dividends made to either EU or residents of a country where we have a double tax agreement. As I mentioned earlier, a very common structure here, certainly for Irish domestic partnerships, would be to have a service company running in tandem with the professional firm. And generally, that service company would provide the back office, let's call them back office services, which would be HR, finance, facilities, those type of services, or non-legal services in a lot of instances, which can be provided through a limited liability entity. And that service then will be provided by the service company to the professional firm. And the partnership, in that instance, the firm would pay a service fee, typically calculated on a markup basis on some or all of its costs, although in limited circumstances the fixed charge can be agreed. Now, the revenue haven't published any kind of indicative markup rates here for what would be acceptable in terms of a markup on a cost-plus basis. The normal range will be in the order of probably between 5 to 7 or 10%. Professional services firm or the partnership obviously receives a tax deduction at its effective rate, which, as I mentioned earlier, is 55, for the service fee paid to the service entity. The service entity then would pay tax on its income at 12.5% on its profits. The main purpose or the main advantage of the service company entity is to facilitate enhanced pension contributions for the partners. We have a limit here in Ireland on the amount of personal pension contributions that can be made for tax purposes, and it is capped at, depending on your age and your level of income, at roughly 30 or 40,000 euro per annum. However, where you have a service company structure, the service company as an employer can also make significant additional employer pension contributions. So the service company structure with the partnership allows partners to increase their annual pension contributions and accelerate building up a pension pot. And that's the main purpose that the service company structure is used for. Bearing in mind that they're the most common structures for professional services firms in Ireland, we have a quick look maybe at some of the issues facing overseas companies, excuse me, overseas companies operating in Ireland. And again, we have the separate, there's a number of ways I suppose you can go with this. One is a separate, sorry, just the slide's gone here, sorry. Separate Irish entity or Irish branch or permanent establishment. In that instance, the Irish branch or permanent establishment will be subject to Irish income tax or corporation tax, depending on the nature of the permanent establishment. Is it a separate partnership or is it a branch of a company? The Irish branch of an overseas partnership, first of all, we would need to look at the nature of the Irish tax status of any overseas partnership. And in general, in our experience, revenue here generally accept, now this is a general rule, that a UK LLP would generally be regarded as a transparent tax entity here in Ireland also. So in other words, the Irish revenue would seek to tax the individual partners of a UK LLP on their Irish source income. In that instance, if you have, for example, a UK LLP operating in Ireland through a branch or permanent establishment, then all of the partners in that UK LLP would be required to file Irish tax returns to reflect their share of the profits from the Irish branch. We don't have the facility here, which you do in the UK, of being able to file a composite partnership return in Ireland. The requirement here would be for every partner in the overseas partnership to file an Irish return to reflect his or her share of the Irish profits. Looking then at an Irish branch of an overseas corporate entity, in that instance the Irish branch would be required to file an Irish corporate tax return, again to reflect profits from the Irish branch. Excuse me. Furthermore, any Irish entity operating in Ireland would need to register for Irish VAT and Irish payroll taxes on the basis of having a presence here and having employees based here and carrying on a business here. In, I suppose, some instances you could end up with an Irish representative office, which is simply, it would have an entity which has no legal status in Ireland, so it wouldn't be incorporated here or established here as a partnership or a company in its own right. It wouldn't have any commercial activities here, but would simply may be involved in business development or market research. In that instance, in a representative office scenario, you would have no Irish tax presence. However, this would need to be very carefully monitored to ensure that no Irish tax, no Irish PE would arise by virtue of an increased level of activity or contracting arrangements in Ireland. Now I'll hand you over to my colleague Mark, who's going to take you through some of the payroll tax obligations and the comments.
Morning, everyone. So I suppose when you're, I'm going to focus on the payroll issues around the foreign employer, the foreign partnership sending assignees or short-term business travellers over to Ireland. I suppose to start off, there is a bit a misnomer that as long as the individual is going to be here for less than 180 days, there'll be no payroll requirement. That is actually factually incorrect. The Irish legislation, the domestic legislation, actually imposes a payroll obligation on the employer if you have an employee working in Ireland for only 1 day a year. Now, on saying that, Revenue don't actually impose that; they take a more practical position on it. But the guidance on this area is quite detailed, and it has been updated on a number of occasions, starting off in 2007 and most recently in December 19. So we'll cover the current state of play with regard to revenue practice in a minute. The key point being that you can have an individual working here for up to 60 work days in a tax year without having any obligation to operate any payroll taxes in Ireland or to make any registrations. If you exceed that 60 days, then you need to determine if you qualify for treaty relief, and if you do so, you must make an application to the Irish tax authorities. If you have assignees coming to Ireland for in excess of 6 months and effectively assignees taking up residency in Ireland, well then consideration would need to be given to whether the employee would qualify for what we call SARP, or Special Assignee Relief Programme. So in terms of the revenue guidance, as I said, the legislation gives Revenue the power to impose a payroll if the individual is here for carrying on work duties for just 1 day per annum. However, with effect from 1 January 2020, there is an automatic exemption if the assignee is coming from a DTA country and will be working in Ireland for less than 60 work days in a tax year. If the individual is coming from a non-DTA country, that threshold falls to 30 work days. As I said, they're automatic exemptions. If you have an assignee coming over here, you're satisfied that they won't exceed the 60 days, you have to make no filing obligations. You make no registrations. There's no reporting into Revenue. It's automatic. The complications come when you have assignees who are more than 60 work days, but less than 183 days in total. The 183 days is a full day test. It's not just work days. If you fall into that category, then you need to determine if you qualify for treaty relief under the relevant tax treaty. So the UK Ireland is Article 15 for employment tax or for employment income. If you fall into that category and you're satisfied that the assignee would qualify for treaty relief, then you must make an application to Revenue within 30 days of the individual first arriving. And the purpose of that application to Revenue is to set out why you would qualify for what's effectively called a PAYE dispensation. And the logic behind the dispensation is that in the absence of it, you must operate a payroll. But if you can show to Revenue that this individual will ultimately qualify for treaty relief and get a full refund of any payroll taxes initially withheld, well then Revenue will take the practical approach and issue a dispensation, and therefore remove you from the obligation to operate payroll taxes in the first place. In order to meet the requirements of the dispensation, it's basically the 4 conditions of the relevant tax treaty. So the individual in question must be resident in Ireland, in a country with which Ireland has a DTA, but can't also be resident in Ireland. There must be a genuine foreign office or employment. 3 and 4 are the more complicated ones. 3 is the remuneration must be paid by or on behalf of an employer who is not resident of Ireland, and then the 4th one is the foreign employer can't have a permanent establishment in Ireland. So the third condition was where revenue's position shifted quite significantly back in 2016. Prior to that, revenue, I suppose, were outliers in terms of their interpretation or their approach to the relevant treaty, whereby they took the view that if the employer from abroad was paying the individual and was effectively following the legal employer approach, then they would issue a dispensation in that condition would be met. However, in 2015, we noticed that an awful lot of dispensations were being challenged and questioned by revenue, and then in 2016, they updated their guidance, whereby they adopted what is known as the economic employer approach, and have effectively taken the OECD interpretation of the relevant article. So what that means in a nutshell is that they're no longer looking at simply who is paying the employer. They're more looking at who is the economic employer, who is instructing the employee when they are in Ireland. So in terms of guidance around the condition 3, one of the key aspects is that the revenue have stated that if the assignee is carrying on duties that are considered to be integral to the business of the Irish entity, irrespective of who the paymaster is, then condition 3 won't be met, and as a result, a dispensation won't be issued and payroll taxes will need to be applied. So in terms of what integral means, integral means, again, revenue have simply adopted the OECD interpretation in full, whereby integral now is you're looking at who is responsible for the assignee when they're in Ireland, who bears the responsibilities and risks of their activities and performance, who is dictating what they do, where they do it, how they do it, who is the assignee reporting into, effectively who is managing the employee while in Ireland. And as part of the dispensation to revenue, you need to set out to revenue how that condition is being met. So for instance, if you have an assignee coming over to Ireland for a 4-month period to cover, let's say, long-term sick leave of an Irish employee, they're simply stepping into the shoes of the Irish employee. They're carrying on those duties of the Irish employee. So even though they're only here for 4 months, they will not meet that condition of not being integral to the Irish business, and as a result, revenue would not issue a dispensation in that scenario. An alternative to that would be, for instance, if you had an internal audit type function whereby head office were sending 2 individuals to Ireland for a 2-month period or 3-month period to carry out extensive tests on the Irish system. They are very much reporting back into head office. They're responsible to head office, and they're taking instruction from head office. So in that scenario, you should get a dispensation. One absolute red line for revenue with regard to issuing dispensations is if there's a direct recharge of the costs of the assignee to the Irish entity. If there is a recharge, then that's an automatic no from revenue's perspective. Just jumping back one slide in terms of the permanent establishment, because I know Eddie mentioned it there a few minutes ago. The permanent establishment scenario is if the remuneration is borne by a permanent establishment which the foreign employer has in Ireland, it's not simply a case of, well, we won't charge that remuneration cost to the permanent establishment. Again, the OECD guidelines are more around if you have the ability or the capability to charge that cost to the permanent establishment, well then that condition will not have been met. It's not simply a case of we just won't book it and therefore we meet that requirement. So in terms of non-DTA, just to touch on it very briefly, The non-DTA scenario is much more straightforward, but somewhat more punitive, in that if you are less than 30 days in Ireland coming from a non-DTA country, then there's an automatic exemption. If you exceed the 30 days, there's an automatic payroll obligation. The reason being that if you exceed the 30 days, you don't have any tax treaty relief to access, and therefore a payroll obligation will exist. So moving on to SARP, our Special Assignee Relief Programme, it's broadly the same type of logic to the 30% ruling that the Dutch tax authorities have, or Luxembourg have an impact regime. It was basically the logic behind it was to attract key executives into Ireland, with a view that if you have key executives based in your jurisdiction, you'll have more substance here, and the likelihood is that more employment will be generated on the back of that. So in order to attract these key executives, the Special Assignee Relief Programme works whereby a percentage of your overall remuneration package is removed from the Irish income tax net. The calculation is quite straightforward. It's basically your total remuneration minus a 75,000 cap, and then the excess at 30% is removed from the income tax net. SARP does not apply to USC or PRSI. Just a quick note on USC. USC is Universal Social Charge, but it's not a social insurance. It's an income tax, and it's also an income tax for the purposes of double tax treaty relief. So in terms of SARP, the excess, the 30% of the excess is completely removed from the income tax net, albeit on remuneration packages capped at €1 million per annum. Additional couple of benefits of SARP is that the employer or the associated company can pay school fees of up to €5,000 per annum per child without it being treated as a tax benefit, and the employer can also cover a return trip to the individual's home country per annum on a tax-free basis, and if their family have relocated with them, the family can avail of that as well. Just a word of warning, it has to be a return trip to the home country. It can't be just to pay for your annual holiday. So in terms of conditions, just to briefly touch on them. So the individual must be an employee of a company incorporated in a tax resident DTA country. Incorporated and tax resident in a DTA country, or in a company that is resident in a country where we have an exchange of information agreement. With regard to that, the legislation specifically says a company and a company incorporated. Obviously, a UK LLP isn't a company, so there is a question mark over whether, if your employer is a UK LLP and they have been assigned to Ireland for a period of time, whether they will qualify for SARP. So a specific application to revenue would probably be required in order to get revenues agreement on that. So back to the conditions. The individual must arrive in Ireland prior to 2022. It was recently extended from 2020 in the most recent Finance Act. The employee also must have been employed by the relevant employer for at least 6 months prior to arriving in Ireland. There has been a push for revenue to remove that, whereby it could be used as a tool to recruit from abroad. However, at the moment, because they have to work for at least 6 months with the relevant employer outside of Ireland, you're very much looking at individuals assigned to Ireland from the wider group network. The individual must be Irish tax resident in the year they claim the relief, and they can claim the relief for 5 continuous periods. The base salary of the individual must be at least €75,000. So again, it's aimed at key executives. So revenue have imposed this minimum base salary of 75,000. So, for instance, if you had an individual who was on a base salary of 70,000 but had a bonus of 100,000 discretionary, they wouldn't meet that requirement. They have to have a base of 75. It does apply to Irish nationals, so it's the key requirement is that the individual must not have been resident in Ireland for 5 years prior to arriving in Ireland. So it's not limited to foreign citizens. It includes both Irish and foreign. One very important criteria of SARP is that if you are availing of SARP, or more importantly, if the employee is going to avail of SARP, the employer must make an application to revenue within 90 days of the individual first arriving in Ireland. If that 90-day test is not met, then SARP will not be SARP clearance will not be issued. It's quite a punitive penalty, given that if you miss the 90 days, it means that the individual can't claim SARP for all of the 5 years. They're completely out. So the punishment doesn't quite fit the crime, but unfortunately that's the condition that is currently set in the legislation, and it is quite strictly applied by Revenue to date. So that is my covering of the payroll issues from the Irish perspective. So if you have any questions.
Thank you both. That's really clear. But we have got some questions, so I'll kick off with those. In terms of the impact that Brexit has had on professional services setting up in Ireland, have you seen a big increase, an influx of businesses setting up there that haven't had a presence before, or people exiting?
There has. I guess Brexit, as you can imagine, has been very topical here over the last, probably even more so maybe than in the UK over the last period of time. I suppose we've seen it in a couple of sectors, mainly in the legal sector, and I think it's firms coming in generally again from the UK, and I think it's probably driven by two things. Obviously, one, Brexit itself, and the fact that Ireland will obviously remain in the EU and be the only Irish-speaking country within English-speaking country in the EU. But also, I think a lot of the firms were following their clients. We've seen quite an influx of funds and reinsurance captives, etc., establishing in our financial services centre here. And I think that some of the certainly larger law firms have been following, if you like, their clients into Ireland. So certainly we've seen it a lot in, as I said, on the legal side. Some of them have come in and just set up their own offices here. One or two, I think, have merged with Irish practices as well. Outside of that, I haven't seen a huge amount in terms of other professions. I say it's mainly around the services, the legal services side of things.
Okay, and what sorts of structures are people using when they're setting up in Ireland now, given you've got the new LLP structure? Has there been a lot of interest in that new structure?
There has, yeah. I mean, it is new, as you said. Literally, it's the 1st of November, 1st of November 2019, although it's been on the statute book since 2015, but that's what the green light, or the button was only pressed in November. I'm not aware that any of them have actually as yet been fully established as Irish LLPs. They may well be in process, because there is obviously a registration process, etc., with the Legal Services Authority here. So as I said, some of them have used, I suppose, the traditional Irish model, which is your general Irish partnership with or without a service company, and I suspect some of them probably are going through the Irish LLP process.
Sure, and can you avail yourself of the pension contribution process that you talked about before, setting yourself up with a personal service company when you've got the new structure, or actually do you need to revert back to using the sort of the tried and tested structure if you want to obtain or get access to the additional pension contributions that you talked about before?
No, you can use the service company with either an Irish, we want to call it established or a traditional general partnership, or with the Irish LLP. The purpose of it, as I said, is to create an employee relationship, which allows the employer pension contribution to be made. As I said earlier, there is a cap. We have a cap here on the amount that an individual can put into a pension fund, and it's a kind of a monetary cap established by reference to your age and the level of income. So that caps you. It varies depending on the rate between 25 and 45,000 euro. But where you have an employer-employee relationship, the employee obviously can contribute that amount as a personal pension contribution, but the employer can contribute a significantly higher amount, basically whatever amount is required to fund a relevant pension pot. So that's the purpose of the service company. It creates an employer-employee relationship between the body corporate and the partners in the professional services firm.
Sure. So you might see some of the new structures being used alongside the services.
I would expect so, because even within the Irish LLP, you're still restricted to, from a pension point of view, you're still restricted to the personal pension contribution, because obviously the LLP doesn't create an employer-employee relationship between the firm and the partners.
Got it. Okay. So there's a couple of questions around permanent establishment and payroll duties. So if you have an example where there is a UK employee that is working based in Ireland, so they've got a home in Ireland and they're based in Ireland, but they're employed by the UK entity, and this individual may be a lawyer, for example. The individual may continue to work on UK clients, so really what they're doing is they're just basing themselves in Ireland but carrying on doing UK work for UK clients. Does that employer need to run an Irish payroll for that individual?
Yes. The issue of the permanent establishment would only... It becomes irrelevant if the individual is going to be based here for more than 183 days, because the first test to get 3 day leave is that you can't be resident in Ireland. So if you exceed 183 days, like the Irish residency tests are basically just a day count. You're either here if you're here more than 183 days in 1 year, or 280 cumulatively over 2 years, you're Irish resident. So if the individual is going to be tax residents, whereby they're based here on an ongoing basis, well then they won't meet all the conditions of the relevant article, and because they're working more than 60 work days, an automatic payroll obligation would kick in. So the issue of the PE would only arise if the individual was less than 183 days, and the third condition would probably be met because you wouldn't have an Irish employer because they're working back to the UK entity. So therefore, it's condition 4 would be the key one, in that does the individual or does the entity have an Irish PE? But because you're talking about a scenario where they're more than 183 days here, or are based on an ongoing basis here, you'd have a payroll.
Yeah, so you've got a payroll obligation, and also you've got a permanent establishment point to ensure that you're
I suppose you'd need to look at that from
separately.
A separate issue, because obviously if you create a PE, then you have the bigger headache of having every partner having to file an Irish tax return for their sliver of the Irish profits.
Yeah. Okay. And so do you want to just run through the permanent establishment point in terms of what might create a permanent establishment? I know you talked about if the individual may be doing some of the preparatory work rather than something else. So do you want to just outline what that might create for this particular individual working on what looks like client work?
Yeah, I guess you're back really to first principles in terms of what is the individual actually doing here. Are they contracting in Ireland? Have they the power to engage with clients or contract on behalf of the firm? If it's an employee of say the UK firm, for example, that's probably less likely than if it were, say, one of the equity partners in who was based here. Certainly, I think if it was one of the partners or equity partners who were based in Ireland, then you would more than likely, I think, in that instance, have a PE. Less likely, perhaps, in the case of an employee, particularly if they weren't providing any services to any Irish clients. Then it's probably less likely you'd have a PE from an income tax perspective. Okay.
So moving on, and I think this looks like it's the last question, so if there's any more out there, then please do send them in. So the question comes in from on payroll, so one for you, Mark, I think. So with regards to payroll obligations, does the 60 days of work include marketing and business development activities? So this is purely from payroll perspective?
Yeah, like the guidance around a workday is not particularly extensive, but it's basically a workday is any part of a day you carry on duties for the employer. So it's not a case of certain duties are out, certain duties are in. It's if you're working for your employer in Ireland for any part of a day, then that is a workday.
Fine, okay, and we actually do have another question. Looks like it's Brexit related. So the question relates to the position after the end of December. So 31 December 2020. So after that date, has there been any guidance on a double tax agreement with the UK once the UK leaves the EU?
Yeah, well, Brexit will have no impact whatsoever on the DTAs. The Ireland-UK tax treaty was in place well before the EU, so that will have no impact whatsoever in terms of Brexit. I suppose from the wider payroll issue would be the social insurance. So if you're in the EU and you're coming to Ireland on assignment, you can get an A1 certificate from your local authority, which would retain you on your home country social insurance system. Obviously, with the UK now stepping out of the EU, they will no longer have the access to these A1s. But on saying that, the Ireland and the UK governments signed reciprocal agreement back in, I think it was February 2019, whereby that reciprocal agreement kicks into life once Brexit becomes once Brexit goes live, which basically means then that we'll get you'll have the ability to get a certificate of coverage as opposed to an A1. Yep. But in terms of tax treaties, there'll be no impact whatsoever from that perspective.
Yeah, and there's no expectation of the treaty changing. We haven't seen anything to suggest that.
Not on our side. We haven't heard anything on our side either.
I don't think I have either, unless it's gone under the radar, which is possible. Right, very good. I think we've come to the end. So, Eddie and Mark, thank you very much for your contribution this morning. Much appreciated. And as I said earlier, that we will be recording, well, we have recorded the webinar, I hope, and the slides and the webinar will be circulated within the next few days. So thank you all for listening, and look forward to speaking with you the next time.
Thank you.
Okay, thanks.